The global financial landscape is quietly undergoing a transformation that most people aren't noticing. Behind the headlines, two of the world's most powerful nations are making calculated moves that could reshape the very foundation of international economics. The US dollar, long considered unassailable, is now facing a challenge unprecedented in recent history. Russia and China, through deliberate and strategic actions, are signaling a new direction, one that questions the automatic supremacy of the dollar in global trade and finance. In recent months, Russia has taken decisive steps that go beyond ordinary economic adjustments. By halting dollar trading on its main financial exchanges, Moscow has sent a powerful message. It intends to reduce its reliance on the US currency and build a more autonomous financial system. This move is not simply a reaction to Western sanctions. It represents a long-term strategy aimed at shielding the Russian economy from external pressure while strengthening its sovereignty. The impact of this decision extends far beyond Russia's borders. Global banks, energy markets, and trade networks all feel the subtle but growing pressure of a nation deliberately stepping away from dollar dependence. At the same time, China is quietly rewriting the rules of international trade. For decades, American farms have supplied billions of dollars worth of soybeans, corn, and other agricultural products to Chinese industries and consumers. This trade relationship not only supported U.S. farmers, but also reinforced the dollar's role as the standard medium for global transactions. Now, China is actively diversifying its suppliers, sourcing critical crops from Brazil, Argentina, Russia, and other regions. Chinese officials have made it clear the country no longer needs American farm imports to sustain its growth. This shift is strategic, not simply economic. It's about reducing dependence on the United States and the dollar itself. Together, these two actions are more than just isolated economic maneuvers. They are signs of a coordinated structural shift in global finance. Russia targets the dollar through currency policy and energy trade, while China undermines its dominance through agricultural and commodity realignment. The result is a dual front that challenges the traditional mechanisms through which the United States has maintained global economic influence for decades. For the U.S., the consequences are potentially profound. Reduced demand for dollars in international trade can lead to higher borrowing costs, weakened economic leverage, and reduced effectiveness of sanctions as a geopolitical tool. Domestic industries, especially agriculture and energy, face declining export opportunities as other nations step in to fill the gap. Over time, this could weaken regional economies, disrupt employment, and force policymakers to navigate a delicate balance between protecting domestic interests and maintaining international credibility. Understanding the roots of the dollar's power is essential to grasp the gravity of these developments. The U.S. dollar became the world's leading currency not by chance, but through decades of economic growth, political influence, and global trust. After World War II, with the Bretton Woods Agreement, the dollar was pegged to gold and became the cornerstone of international trade. As oil and commodities were priced in dollars, a global network of dependence formed, giving the United States unprecedented financial leverage. Even after the gold standard ended, the dollar retained its dominance, serving as the primary reserve currency for central banks, the preferred medium for international trade, and the benchmark for global debt. However, this dominance carries inherent vulnerabilities. The dollar's power relies on consistent global demand and confidence in U.S. economic stability. When nations like Russia and China actively reduce their exposure to the dollar, it chips away at one of the foundations of U.S. economic influence. Russia's shift toward local currencies and gold reserves and China's diversification of agricultural imports represent structural challenges that cannot be easily reversed. Over time, fewer global transactions denominated in dollars reduce liquidity, weaken the currency's strength, and limit the United States' ability to project financial power globally. The consequences extend beyond finance. Energy markets, trade relationships, and global commodity flows are all interconnected with dollar transactions. As Russia sells oil and gas in rubles or yuan, and China sources crops outside the U.S., traditional supply chains are disrupted. Emerging markets, observing these shifts, are increasingly exploring alternatives to dollar-based trade, experimenting with local currency settlements and bilateral agreements. This gradual move toward a multipolar economic framework introduces both opportunities and challenges, creating a world where multiple financial centers hold sway, each with its own rules and preferred systems. In this evolving landscape, the United States faces a strategic choice. How it responds to these shifts will determine whether it maintains a core of dollar-reliant allies or accelerates the decentralization of global finance. Strengthening alliances, investing in domestic competitiveness, and exercising careful diplomacy are essential strategies to navigate this new reality. Missteps could further accelerate the erosion of U.S. influence, while a calculated approach could preserve economic leverage and reinforce confidence in the dollar. As we explore the implications of these developments, it becomes clear that what we are witnessing is not a temporary fluctuation. Russia and China are setting in motion a long-term restructuring of global finance and trade. The era of unquestioned U.S. dollar dominance is being tested, and the decisions made by policymakers, businesses, and investors in the coming years will shape the trajectory of the global economy for decades. Stay with us as we continue this analysis in the next parts of this series, breaking down the mechanics of Russia's financial independence strategy, China's agricultural realignment, and what these shifts mean for the future of U.S. economic power and global currency dominance. To fully grasp the significance of the current shift, we need to understand the deliberate strategies both Russia and China are employing. Russia's recent moves go far beyond simple reactions to sanctions or geopolitical tensions. For over a decade, Moscow has been quietly restructuring its financial architecture to reduce dependency on the U.S. dollar. After the sanctions following the 2014 crisis, Russia realized that its deep reliance on the dollar left its economy exposed. Access to global finance could be restricted at any moment, potentially freezing assets or halting critical transactions. In response, Russia systematically diversified its foreign reserves. Dollar holdings were steadily reduced, while the shares of euros, yuan, and gold increased. Gold, in particular, became a cornerstone of financial resilience, providing a tangible store of value that is difficult to target or seize. At the same time, Russia encouraged trade in national currencies with strategic partners such as China, India, and Turkey. Energy exports, historically almost entirely priced in dollars, began to be settled in rubles or yuan. Large corporations and state enterprises followed suit, gradually creating a parallel system that bypassed the dollar. This strategy culminated recently with the Moscow exchange halting dollar and euro trading. While it may appear symbolic, the implications are profound. Domestic banks and businesses now rely primarily on the ruble, yuan, or regional currencies for settlement. This deliberate reduction of dollar demand signals a rapid acceleration toward financial independence. The move is not just about insulating the economy from sanctions, it's about reshaping Russia's long-term position in global finance. By creating alternative pathways, Moscow is constructing a system capable of functioning independently, even under sustained external pressure. China's approach, while different in execution, mirrors the same strategic objective: reducing dependence on the United States and the dollar. For decades, American agriculture played a pivotal role in feeding China's industrial and consumer sectors. Massive imports of soybeans, corn, and other key commodities not only generated billions in revenue for U.S. farmers, but also reinforced the dollar's global circulation. However, recent years have seen a deliberate pivot. China is sourcing major agricultural commodities from Brazil, Argentina, Russia, and other regional players, intentionally reducing reliance on U.S. suppliers. This shift is strategic and multidimensional. It safeguards China's food security while simultaneously weakening the traditional economic leverage Washington held through agriculture. By diversifying suppliers and investing in domestic production, China is building resilience against potential sanctions, trade disruptions, or geopolitical pressures. Furthermore, some of these deals are settled in local currencies or alternative financial arrangements, signaling an incremental move away from dollar-denominated trade. When examined together, the actions of Russia and China form a coordinated challenge to U.S. global financial dominance. Russia undermines the dollar from the financial and energy side, while China chips away through trade and commodity adjustments. Their actions, whether intentionally synchronized or coincidental, reinforce each other, slowly establishing a network of economic activity less reliant on the dollar. This creates a structural challenge for the United States, threatening to erode both financial leverage and the effectiveness of economic sanctions as instruments of geopolitical influence. The impact of this dual-front strategy extends far beyond these two nations. Emerging markets are taking note, increasingly exploring alternatives to the dollar-based system. Central banks in Asia, Latin America, and Africa are experimenting with local currency trade, currency swap lines, and bilateral agreements that bypass the dollar entirely. Even smaller nations are strategically positioning themselves along these emerging networks, aligning with regional financial hubs and building trade arrangements that reduce exposure to U.S. economic policy. For the United States, these developments create a complex challenge. Fewer global transactions in dollars weaken the currency's liquidity, reducing its global influence. Dollar-denominated debt becomes more expensive to service as demand shifts, while investors begin questioning the stability of a currency facing declining global usage. Domestic industries, particularly agriculture and energy, face declining export opportunities and increasing competition from countries now supplying China, Russia, and other markets directly. This has a cascading effect on employment, regional economies, and ultimately, political stability. These transformations are not sudden. They are the product of long-term strategy and calculated risk. Russia and China are building financial and trade systems designed to endure external shocks, bypass dollar dependency, and protect their national sovereignty. As these alternative networks expand, the global system gradually becomes more multipolar, with influence divided among several financial hubs from Shanghai and Dubai to São Paulo. The old structure of dollar dominance, while still influential, is increasingly challenged by emerging economic alliances and diversified trade flows. In this evolving environment, every decision by the United States carries heightened consequences. Policies affecting trade, tariffs, and diplomacy must account for this shifting landscape. Missteps could accelerate the erosion of U.S. influence, while strategic engagement, investment in domestic production, and strengthening of alliances could preserve core leverage in the dollar-based system. Ultimately, the moves of Russia and China are not isolated events. They signal a profound and permanent recalibration of global economic power, one that will shape trade, finance, and geopolitical dynamics for decades to come. As we continue to explore the broader implications of Russia and China's strategic shifts, it becomes clear that the global reliance on the US dollar is entering uncharted territory. The dollar has long been the linchpin of international finance, shaping trade flows, investment patterns, and even geopolitical leverage. But the recent movements of these two economic giants highlight a structural vulnerability in a system that many assumed was unshakable. Russia's ongoing efforts to reduce dollar dependency have been methodical and multi-layered. Beyond halting dollar trading on the Moscow exchange, the Kremlin has expanded bilateral agreements with key trading partners, creating mechanisms that bypass dollar clearing entirely. These agreements often involve direct currency swaps, local currency settlements, or commodity-backed transactions. The goal is to create a network of transactions that can function independently of U.S. financial systems, effectively insulating Russia from potential sanctions or restrictions. At the same time, Russia is strengthening its domestic financial infrastructure. By encouraging banks and corporations to hold reserves in rubles, yuan, and gold, Moscow is building resilience against external pressures. Large-scale state-owned enterprises, including major energy exporters, are increasingly transacting in non-dollar currencies, which reduces exposure to the fluctuations and control associated with the U.S. currency. This calculated approach not only mitigates risk, but also signals a broader ambition, a move toward true economic sovereignty that allows Russia to operate on its own terms, free from the influence of Washington or European financial institutions. China's approach, while different in execution, complements the challenge posed by Russia. Agriculture has been a cornerstone of U.S. influence, and by diversifying its sources of food imports, China has effectively reduced Washington's leverage. American soybeans, corn, wheat, and meat once formed the backbone of China's agricultural imports, ensuring billions of dollars flowed through U.S. channels and reinforcing the currency's global role. Now, by shifting purchases to Brazil, Argentina, Russia, and other suppliers, China is redistributing trade flows and simultaneously establishing a buffer against potential economic coercion. This strategic diversification is paired with deliberate currency maneuvers. Many of China's new trade agreements are settled in local currencies or through alternative settlement systems that bypass the dollar. By doing so, Beijing is effectively testing a parallel financial framework that, if scaled, could significantly reduce global dependence on U.S. currency transactions. The long-term implication is clear. China is preparing for a world where trade and finance can operate independently of the dollar, creating a more multipolar financial system. The combined impact of these strategies is far-reaching. When two of the largest economies actively reduce their reliance on the dollar, the consequences ripple across global markets. Central banks and financial institutions worldwide are forced to reconsider reserve strategies, hedging practices, and trade settlement approaches. Emerging markets, in particular, are watching closely, identifying opportunities to decouple from the dollar and adopt local or regional currency arrangements. For instance, Latin American nations are exploring cross-border payment frameworks that bypass the dollar entirely. Southeast Asian central banks are testing currency swap lines that allow direct exchange between regional currencies. In Africa, countries are forming trade agreements with both China and Russia, positioning themselves within an alternative financial network. This gradual decentralization of global finance represents a quiet but profound shift in economic power. The implications for the United States are significant. The dollar's dominance relies on constant demand from international trade and reserves. As Russia and China diminish their use of the dollar, global demand begins to erode. Fewer transactions in dollars mean less liquidity in international markets, which can reduce confidence in the currency. Investors may begin to question the stability of dollar-denominated assets, driving up borrowing costs for the U.S. government. Domestic industries, particularly those heavily reliant on exports, face declining market share as new suppliers fill the void left by the United States. Moreover, the economic pressure extends beyond finance and trade. U.S. geopolitical leverage, historically reinforced by dollar dominance, faces a test. The ability to impose sanctions, influence international agreements, and control financial access is weakened when alternative networks bypass the dollar. Nations observing Russia and China may accelerate their own decoupling strategies, creating an environment where U.S. influence is no longer automatic or assured. At a practical level, this shift introduces complexity and volatility. Countries trading in multiple currencies must manage exchange rate risks. Financial institutions must adapt to fragmented systems, and global investment flows may become less predictable. The transition is not instantaneous, but the trajectory is unmistakable. A more multipolar financial landscape is emerging, one that redistributes power away from the United States and toward a constellation of regional hubs. From the perspective of Washington, the challenge is twofold. First, to maintain the core network of dollar users, including allies and key trading partners. Second, to adapt domestic policy to ensure the U.S. remains economically competitive. Strengthening alliances, investing in infrastructure, and supporting export industries become critical tools for preserving influence. At the same time, diplomacy and trade engagement are essential to prevent unnecessary acceleration of dollar decoupling by neutral nations. The window for action is narrow. As Russia and China continue to implement long-term strategies, the pace of change could outstrip U.S. responses. The global financial system, while robust, is not immune to strategic realignment, and each transaction that moves outside the dollar network weakens the currency's centrality. Over time, this could lead to a scenario where the United States must compete in a world of multiple financial centers, each with its own preferred currencies, settlement systems, and trade networks. In essence, what we are witnessing is more than a temporary adjustment or geopolitical maneuvering. It is the gradual reshaping of the global financial architecture, where dollar dominance faces sustained structural pressure. Russia and China are setting the stage for a multipolar economy, and the United States must recognize that its traditional mechanisms of economic leverage may no longer function as reliably as before. This evolving reality has profound consequences for businesses, investors, and policymakers alike. Understanding the strategic moves of Russia and China and the ripple effects across global finance is critical for preparing for the next phase of economic competition. The era of unquestioned dollar supremacy is being challenged, and those who fail to comprehend the depth of this transformation may find themselves unprepared for the new global order that is quietly emerging. As the world watches, the consequences of Russia and China's strategies are beginning to materialize in subtle yet significant ways. Global trade patterns, currency flows, and even investment decisions are showing early signs of recalibration. What makes this shift particularly impactful is its quiet, incremental nature. It is not a sudden collapse or a dramatic headline event. Instead, it is a gradual undermining of a system that has been central to global economic stability for decades. For Russia, the move away from the dollar is part of a long-term strategy to assert economic sovereignty. By reducing reliance on the U.S. currency, the Kremlin limits the potential damage from Western sanctions and financial restrictions. Every transaction settled in rubles, yuan, or gold reduces Moscow's vulnerability and increases its control over domestic and international economic activity. Large-scale energy contracts are now structured in a way that ensures continued revenue streams without exposure to the dollar. Similarly, domestic banks and corporations have adapted to operate efficiently without relying on U.S. dollars, creating a self-contained financial ecosystem that challenges the assumption that global trade must pass through the dollar system. China, meanwhile, is approaching the situation from a complementary angle. The country's shift in agricultural imports, once dominated by U.S. products, represents a deliberate reduction in dependency and a strengthening of global resilience. By sourcing key commodities like soybeans, corn, and wheat from Brazil, Argentina, Russia, and other suppliers, Beijing is not only diversifying its supply chain, but also creating economic leverage outside of Washington's influence. These moves are strategic, intended to mitigate risk and ensure long-term stability in the face of geopolitical tensions. China's focus extends beyond food. The nation has invested heavily in building infrastructure, supply chains, and trade networks that operate independently of the dollar. From ports and shipping routes to trade financing and settlement platforms, China is creating an integrated system that reduces exposure to currency fluctuations and political pressures. Local currency agreements, digital settlement mechanisms, and barter-style transactions are becoming increasingly common in trade with key partners, signaling a readiness to operate outside of the traditional dollar framework. The cumulative effect of these changes is a slow but undeniable shift toward a multipolar financial system. For decades, the dollar served as the primary medium for trade, investment, and reserves, effectively granting the United States enormous economic and political influence. As Russia and China implement these alternative mechanisms, the global financial architecture becomes more complex, fragmented, and less reliant on a single currency. This creates both opportunities and risks. On one hand, countries now have greater flexibility to manage trade, finance, and reserves according to their own strategic priorities. On the other hand, the proliferation of multiple currencies and systems introduces potential volatility as exchange rates, credit flows, and liquidity management become more challenging. Emerging markets are particularly affected. Many nations in Latin America, Africa, and Southeast Asia have long been dependent on the dollar for trade and borrowing. Now, they are observing Russia and China's moves and experimenting with alternative arrangements. Currency swap lines, local currency settlements, and regional payment networks are increasingly considered viable options. These initiatives, while still in their early stages, represent a deliberate attempt to reduce dependence on the dollar and create greater financial autonomy. The potential consequences for the United States are significant. As countries diversify away from the dollar, global demand for U.S. currency decreases, reducing liquidity in international markets and potentially undermining confidence in dollar-denominated assets. Investors may begin to question the reliability of the currency, affecting borrowing costs and investment flows. the economic pressure extends beyond finance into trade and production. For instance, U.S. farmers face declining exports as China shifts its purchases to other countries. American producers lose revenue, market share, and long-term competitiveness, while foreign suppliers gain opportunities and expand influence. This dynamic illustrates a broader truth. The dollar is not only a currency, but also a mechanism of economic leverage. Every transaction diverted from the dollar network weakens U.S. influence incrementally. Meanwhile, the United States is contending with domestic challenges that amplify the global shifts. High national debt, persistent inflation, and political divisions complicate the ability to respond effectively. Geopolitical instability, from Eastern Europe to the Pacific, adds further strain. In this environment, even modest changes in trade and currency flows can have outsized effects, creating compounding pressures that challenge traditional U.S. dominance. The synchronized nature of Russia and China's strategies is especially concerning. Russia targets the dollar from financial and energy perspectives, while China focuses on trade, commodities, and agriculture. Together, they impact both the supply and demand sides of the U.S. economic influence equation. Even if cooperation is informal or opportunistic, the effect is amplified because each nation reinforces the other's efforts. The result is a network of economic activity operating increasingly outside U.S. control. Financial fragmentation also introduces risk for the global system. Multiple currencies in use for trade, investment, and reserves create potential instability in exchange rates. Countries must manage new layers of currency risk. Liquidity management becomes more complex, and investment flows may shift unpredictably. Emerging markets with limited reserves or weaker monetary systems are particularly vulnerable. The traditional predictability of the dollar-based system is giving way to a multipolar framework where the rules are less centralized and more nuanced. Energy and agriculture, two sectors historically dependent on the dollar, are realigning alongside financial systems. Russia's energy exports, increasingly priced in rubles and yuan, challenge the petrodollar system. China's agricultural diversification redirects global trade flows away from the United States, with Brazil, Argentina, and Russia filling the gap. Smaller nations are becoming increasingly influential along these new trade routes, while supply chain and production networks adapt to alternative currencies and payment platforms. The result is a redistribution of economic power. Regions previously considered secondary in global trade, Asia, South America, and parts of the Middle East, are gaining strategic importance. The United States' ability to leverage economic influence through dollar dominance faces increasing limitations. This transformation is gradual, but its trajectory is unmistakable. The global system is moving toward a more distributed, multipolar financial and trade environment. For policymakers and investors, understanding these trends is essential. The shifts are not isolated incidents or temporary reactions. They are part of a calculated long-term strategy by two of the world's most powerful nations. The implications for global finance, trade flows, and geopolitical influence are profound. Those who underestimate the pace and significance of these developments may find themselves unprepared for the evolving landscape. In conclusion, the moves by Russia and China represent a turning point. The world is quietly transitioning toward a system less dependent on the U.S. dollar, with long-term implications for finance, trade, and global power dynamics. The path ahead requires careful observation, strategic adaptation, and a recognition that the assumptions of past decades no longer hold true. As Script 3 reaches its conclusion, the full magnitude of the global shift away from the U.S. dollar becomes clearer. The combined strategies of Russia and China are not isolated economic adjustments. They are deliberate steps toward a new global order, one where financial and trade influence is distributed more broadly across multiple powers. Understanding these moves is crucial, as they provide insight into how economic dominance can shift quietly but profoundly, affecting everything from currency stability to trade dynamics, investment flows, and geopolitical leverage. The financial implications of these shifts are profound. By gradually reducing their reliance on the US dollar, Russia and China are slowly eroding the mechanisms that have allowed Washington to project influence globally. Dollar-denominated transactions, once the lifeblood of international finance, are being partially replaced by local currencies, gold, or alternative payment systems. Over time, this reduces the circulation of dollars in global markets, potentially weakening the currency's value and limiting the United States' ability to influence global monetary policies. Investors, central banks, and multinational corporations all begin to adjust their strategies, reallocating reserves, diversifying currency exposure, and reconsidering the risks of dollar dependency. The ripple effects extend beyond finance. In trade, China's decision to reduce U.S. agricultural imports has far-reaching consequences. The United States, which once enjoyed a near monopoly in supplying soybeans, corn, and other critical commodities, now faces declining demand and shrinking market share. American farmers, logistics networks, and rural economies bear the immediate brunt of these changes. Meanwhile, countries such as Brazil, Argentina, and Russia benefit by expanding exports to China, earning revenue in local or alternative currencies. This diversification diminishes Washington's traditional leverage, showing that economic power is as much about supply chains and trade partners as it is about currency control. Energy markets are also transforming. Russia's move to price oil and gas in rubles, yuan, or other non-dollar currencies challenges the petrodollar system that has dominated energy trade for decades. Nations dependent on energy imports must adapt to new settlement structures, creating more resilient but also more complex systems. As energy and agriculture transition away from dollar-based transactions, the global economy becomes less centralized, reducing the United States' ability to dictate terms in critical markets. Emerging economies are especially influenced by these developments. For decades, dollar dependence made many nations vulnerable to U.S. monetary policy shifts, whether through interest rate changes, inflationary pressures, or sanctions. Now, witnessing Russia and China operate outside the dollar system, these countries are experimenting with local currencies, bilateral agreements, and regional financial networks. Latin American, African, and Southeast Asian economies are exploring currency swap lines and cross-border settlement systems that bypass the dollar entirely. This diversification reduces vulnerability, allowing nations to maintain economic stability even amid global disruptions, while also challenging the previously unassailable position of the dollar. The geopolitical consequences are equally significant. Dollar dominance has long been a tool of U.S. influence, enabling Washington to impose sanctions, regulate trade, and maintain leverage over global partners. As other powers reduce their reliance on the dollar, the effectiveness of these measures diminishes. Countries that were once constrained by U.S. policies gain strategic independence, recalibrating alliances and establishing alternative systems that prioritize resilience and autonomy. The result is a gradual shift in the global balance of power, one that redistributes influence across multiple regions and actors. From a strategic perspective, the United States faces a complex challenge. Maintaining the dollar's primacy requires a combination of domestic stability, economic competitiveness, and diplomatic finesse. Washington must strengthen alliances with key partners in Europe, Asia, and the Indo-Pacific, ensuring that trade and investment remain attractive within the dollar-based system. At the same time, innovation, infrastructure investment, and industrial competitiveness are necessary to sustain the global appeal of U.S. products and services. Diplomacy plays a crucial role as well, offering trade incentives, aid, and partnerships to maintain confidence in the dollar while demonstrating that cooperation with the U.S. remains beneficial. However, missteps carry risks. Heavy-handed attempts to enforce dollar dependence through sanctions or trade restrictions may accelerate global dollarization as nations seek to insulate themselves from perceived coercion. Escalating trade tensions or retaliatory measures could disrupt global supply chains and drive countries further into alternative networks. Confidence in American economic leadership depends not only on power, but also on predictability, reliability, and fairness. Any erosion of trust could compound the pressures already arising from Russia and China's coordinated strategies. The long-term vision of Russia and China is clear. Create financial and trade systems resilient to U.S. influence. Diversify currency exposure and reduce reliance on dollar-dominated markets. These efforts are not temporary reactions, but deliberate, structural adjustments designed to withstand economic, political, and geopolitical shocks. The transformation is gradual, yet its effects are systemic. Each transaction moved away from the dollar, each new bilateral agreement, each energy or agricultural deal settled in alternative currencies contributes to a broader realignment of global power. For ordinary citizens, the implications are indirect but tangible. Dollar weakness could lead to higher import costs, increased inflation, and changes in interest rates that affect mortgages, loans, and investment returns. Declining U.S. export markets may impact domestic employment in industries reliant on international trade. More broadly, the shifting global balance may influence international relations, alliances, and security considerations that ripple back to everyday life. The lessons are stark and urgent. First, dollar dominance is not guaranteed. It depends on constant global demand, trust, and systemic stability. Second, trade and finance can shift rapidly when major powers prioritize sovereignty and resilience. Third, the United States' economic leverage, while still significant, faces mounting challenges from nations actively building alternatives. Russia and China's moves highlight that global economic structures are no longer static. They evolve based on strategic priorities, geopolitical pressures, and calculated policy decisions. In conclusion, the era of unquestioned dollar supremacy is being tested. Russia's financial independence strategy and China's agricultural realignment signal a broader trend: the rise of multipolar financial and trade systems. The global economy is entering a period of complexity, competition, and fragmentation, where multiple currencies, regional networks, and alternative mechanisms coexist. For Washington, the challenge is to adapt, innovate, and preserve influence without provoking accelerated dollarization. The shifts we are witnessing are not temporary. They represent a permanent recalibration of global economic power. For investors, policymakers, and citizens alike, understanding these dynamics is essential. The world is moving toward a more diversified financial landscape, and the actions of Russia and China serve as both a warning and a roadmap for how economic power can be reshaped quietly but decisively. The narrative is clear. The global financial system is no longer dominated by a single axis. The dollar remains powerful, but its supremacy is being questioned in practice by two of the world's most influential nations. The era of automatic U.S. financial influence is ending, replaced by a multipolar reality where strategic planning, alternative networks, and diversified trade and currency systems define global power. The consequences of this transformation will unfold over years, affecting finance, trade, geopolitics, and daily economic life. Understanding it today is essential for navigating the uncertainties of tomorrow.